That is the number you need to sit with before anything else I tell you today makes sense. 2. 3 trillion in United States government bonds, or sold, liquidated, exited. Gone from the hands of the people who held them for decades and moved somewhere else. Not slowly, not quietly. Moved with urgency in a window of time so compressed that the mainstream financial media either did not notice or decided you did not need to know. And here's the thing about 3 trillion. Money does not disappear. It does not evaporate off a ledger. It moves. It transforms. It shows up somewhere else, on a different balance sheet, in a different vault, underneath a different price chart. And right now, if you know where to look, you can see exactly where $2, 3 trillion is showing up. And it is not in the place the Federal Reserve wants you watching. If you hold physical gold or silver, if you have been accumulating metal because something about the paper system felt wrong to you, what I am about to show you is the confirmation you have been waiting for. Because the Treasury dump is not a random event. It is not a reaction to interest rates. It is not a portfolio adjustment. It is a vote by the largest institutional holders on earth that the dollar system, the system that has priced your gold and your silver at a suppressed number for 50 years, is approaching a structural break. And the paper price has not caught up yet. That gap between what paper says and what the world is actually doing our routes, that is where we are going today. Let me give you the isolated data point first. One number, just one. In the 12 months ending March 2026, foreign holders of US Treasury securities reduced their combined position by $2, 3 trillion. That is not a rounding error. That is not seasonal rebalancing. The total foreign-held Treasury market is approximately $8, 5 trillion. They just dumped 27% of it. Let that land. More than 1/4 of all U.S. debt held by foreign governments, sovereign wealth funds, and central banks was sold in 12 months. Now here is where most analysts stop. They show you the number, they say rising yields, they say dollar strength concerns, and they move on to the next chart. But that explanation only works if you do not ask the next question. And the next question is, what changes everything? Where did the money go? Because Treasury sellers do not hold cash. Not at that scale. When a sovereign fund or a central bank exits $200 billion in U.S. bonds, they do not put it in a savings account. They rotate, they move into another asset class, and when you track the destination of that $2, 3 trillion, you find something that the paper price of gold and silver has not yet priced in our row, and that is where this story gets serious. But that is not the part that should concern you yet. Let me show you who was selling first, because the identity of the sellers matters as much as the number. Japan, the largest foreign holder of U.S. Treasuries, they have reduced their position from $1, 28 trillion in 2022 to approximately $1, 6 trillion as of early 2026. That is 220 billion out of Japanese hands. China, they peaked at $1, 32 trillion in 2013. As of February 2026, their position is $754 billion. That is 566 billion sold over 12 years of Drobo. But here is what the timeline does not show you. The pace accelerated. From 2022 to 2026, China's monthly selling averaged 3 times the rate of the previous decade. 3 times. Belgium Azobro, which financial analysts widely understand to be a proxy custody account for other central banks, Azobro, reduced its position by $180 billion in 14 months. Saudi Arabia, the United Kingdom, Singapore, all net sellers. Now you have a pattern, not one country adjusting. Not a reaction to one policy decision. Multiple sovereign actors across multiple continents, across multiple political relationships with Washington, all moving in the same direction at the same time. And when that happens abruptly, when entities with no coordination agreement, no common political agenda, and no shared financial motivation all make the same trade, you have to ask what they all see that the retail investor sitting in front of a paper silver chart does not. But here's where I want you to really pay attention, because the pattern multiplies. And it multiplies in a direction that paper prices have not acknowledged. The IMF publishes what is called the COFR Report, Our Currency Composition of Official Foreign Exchange Reserves. It tracks, across 149 countries, what central banks are holding in their reserves. In Q3 2025, the dollar's share of global reserve currency holdings fell to 57.3%. That is the lowest reading since the data series began in 1999. In 1999, the dollar was 71% of global reserves. It is now 57.3%. And the pace of decline is not slowing. It accelerated in 2024 and again in 2025. Paper says the dollar is fine. The reserve data says something different. And if you are watching this channel for the first time, subscribe right now, because this is the kind of analysis you are not going to find on Bloomberg or CNBC. I break down what the big institutional players are actually doing versus what they are saying publicly. Hit subscribe and hit the notification bell. because what I'm going to show you next is the direct connection between this treasury liquidation and the price of the metal sitting in your stack right now. Back to the question nobody is asking loudly enough, where did $2, 3 trillion go? Some of it went into European bonds, some into Japanese government debt. But here is the anomaly that stopped me cold when I was building this analysis. Central bank gold purchases. In 2022, central banks bought 1,136 tons of gold, or the highest annual purchase since records began in 1950. In 2023, they bought 1,037 tons. In 2024, 1,045 tons. 3 consecutive years of over 1,000 tons per year. The previous record before 2022 was 645 tons, set in 2011. This number does not exist in a fair market. In a world where the dollar is stable and treasuries are trusted, central banks do not triple their gold purchases for 3 consecutive years. They do not abandon their reserve currency and buy a metal simultaneously unless they are preparing for a system where that reserve currency is worth less EUR, or worth nothing RO, than it is today. The paper price of gold and silver has acknowledged some of this. Gold moved from $1,800 in 2022 to over $5,000 in early 2026. But silver? Silver went from $22 to a peak of $121 before the manufactured crash. And even after all of that movement, silver is still being priced in the paper market as though this treasury liquidation is not happening. As though 1,000 tons per year of central bank gold demand is a seasonal curiosity rather than a structural signal. The West is still pricing silver like 2019. The vault numbers are telling a completely different story. Here is where I need you to slow down and stay with me. Because the connection I am about to draw ARO between the Treasury dump, the COMEX paper ratio, and the Shanghai physical premium ARO is the core of everything that is happening in the silver market right now. And once you understand the ratio, the price action makes sense. Let me start with COMEX. The COMEX exchange in New York is where the paper price of silver is set. It is where futures contracts underwear paper promises to deliver silver at a future date underwear trade in volumes that dwarf the actual physical market. On any given day, COMEX trades contracts representing 300 to 400 million ounces of silver. The total global annual mine production of silver is approximately 835 million ounces. So in any single day, COMEX trades more than a third of annual global supply of euros in paper. Now here is the number that is impossible to rationalize. The registered inventory at COMEX, the silver that is actually in the vaults, available and certified for delivery against those paper contracts AERU, stands at approximately 34 million ounces as of late April 2026. 34 million ounces available. Contracts outstanding representing 760 million ounces of claims. That is a ratio of 22. 4 paper claims for every real ounce. But wait, it gets worse, because that 760 million ounce figure only captures the registered open interest. When you include OTC derivatives, IRRO, the off-exchange bilateral contracts between banks and institutions that never appear on the COMEX order book, AZRO, academic estimates put the true paper-to-physical ratio somewhere between 200.1 and 356.1. 356 paper claims. 1 real ounce. This number does not exist in a fair market. In any other commodity, awaro, wheat, oil, copper, awaro, if the paper-to-physical ratio approached 10:1, regulators would intervene. 356.1 only exists because the dollar system depends on the price of gold and silver staying suppressed. Because if silver is $300 and gold is $10,000, the implicit message to every government and every saver on earth is that dollars are worthless. And that message cannot be allowed to go out. Not officially. Not through the price mechanism. But the Treasury dump is sending it anyway. And here is what that means for the paper-to-physical ratio right now. When foreign central banks sell treasuries and buy gold, they are not buying paper gold. They are not buying GLD, the ETF. They are taking physical delivery. Allocated accounts. Serial numbered bars moved into sovereign vaults. They are removing real metal from the system. Every ton of gold a central bank takes into physical custody is a ton that cannot back paper claims. And as the physical backing of the paper market shrinks, the ratio expands. It gets more extreme. The system becomes more fragile. The gap between paper say and vault reality widens until it cannot. But that is not the part that should concern you most right now. Let me show you what is happening in Shanghai. Because the Shanghai Futures Exchange tells you what the physical market ADRPRU, uncorrupted by COMEX paper manipulation, ADRPRUs, actually believes silver is worth. As of the last week of April 2026, the silver price on SHFE converted to dollars is running approximately $28 above the COMEX spot price. Let me say that again. Shanghai physical silver is trading $28 higher per ounce than the official COMEX price that your broker quotes you. In percentage terms, that is a 28 to 31% premium ADRO, depending on which day you look. The premium held through the entire dump, through every margin hike, through every coordinated paper sell cascade, Every single time COMEX crashed the paper price, the Shanghai physical premium expanded, not contracted, expanded. Because buyers in China are not looking at the COMEX screen and saying the price is $90. They are looking at their vault demand, their industrial consumption requirements, and their strategic stockpile mandates A0, and they are paying what physical silver is actually worth in the real world. This is the divergence. Paper says one number, the vault says something different, and the gap is not closing. Now let me bring in JPMorgan, because no analysis of the silver paper market is complete without understanding who sits at the center of it. JPMorgan currently holds the largest known private silver position in history, approximately 750 million ounces of physical silver built over 15 years. They paid a $920 million fine to the CFTC in 2020 for silver market manipulation, for what prosecutors described as spoofing, the practice of placing massive fake sell orders to drive the price down and then buying the dip with the other hand. They paid the fine, they kept the silver, they kept accumulating. Between June and October of 2025, JPMorgan closed their entire short position in silver futures for the first time in their institutional history. They are now net long. The same bank that was convicted of suppressing the silver price is now positioned to profit from it going up. And they hold 750 million ounces. Every single dollar silver rises, JPMorgan earns $750 million. At $200 silver, that is $75 billion in profit. Wall Street is not confused. They know exactly what this means. Now connect this to the Treasury dump. The countries dumping US Treasuries, China, Japan, the Gulf states, are the same countries buying physical gold and silver at premiums of 20 to 40% above Western paper prices. China has restricted silver exports since January 2026. They have classified silver as a strategic national security asset. They are simultaneously selling paper dollar assets and buying physical metal assets. They are voting with $2. $3 trillion that the dollar-denominated paper price of precious metals is fiction. And JPMorgan, the most politically connected financial institution in America, positioned themselves physically ahead of this vote. Once is accident, twice is coincidence, 3 times is policy. And this is the 3rd time in 50 years that this pattern has appeared. In 1971, Nixon closed the gold window the moment when dollars officially became disconnected from physical gold. In the years leading up to that break, foreign governments had been dumping dollars and buying gold at a rate that made the official 35 per ounce price impossible to maintain. The paper said 35s, the physical said something different. On August 15th, the paper caught up. Silver went from $1.40 in 1971 to $49 in January 1980, a 35 times move. In 2008, the COMEX paper to physical ratio expanded dramatically as Lehman collapsed and credit markets seized. Physical silver became difficult to source even as the paper price crashed. Premiums on American Silver Eagles hit 50% and higher. The paper said 8. The vault said something different. Between 2008 and 2011, silver moved from 8 to 49s again. Same playbook, different decade. And right now, you have a simultaneous occurrence of 3 conditions that preceded both of those moves. Foreign governments dumping dollar assets at an accelerating rate, the COMEX paper-to-physical ratio at historically extreme levels, and JPMorgan, the institution with the best information in the world, we're sitting on 750 million ounces of physical metal with no short position. The pattern is not subtle. It is not hidden. It is written across 3 different data sets in plain sight. The question is not whether you can see it. The question is whether you understand what it means for what comes next. If you are finding this analysis useful, this is the moment to subscribe to the Hidden Economy. I am going to keep building this picture with you in real time as the data comes in. Subscribe and turn on the bell because the next data point I am watching could land any week and you do not want to miss it when it does. Let me tell you who gets hurt first. Because there are always 3 categories of people in a structural market break, and understanding which category you are in right now is the most important financial decision you will make this year. The first category, people holding paper silver. ETFs, futures contracts, unallocated accounts at bullion banks. These instruments are built on the assumption that the COMEX ratio is stable, that when you want out, someone can deliver, that the paper claim is equivalent to the metal. That assumption is currently held together by a ratio of 22 to 356 to 1, depending on which layer of the derivative stack you are measuring. Here's the question you need to answer about your paper position. If 5% of paper silver holders demanded physical delivery simultaneously, could the system deliver? At a 22-1 ratio, the answer is mathematically no. At 356-1, the system fails if 1% of holders want out. This is not theoretical. This is what happened in 1980. This is what JPMorgan is preparing for with 750 million physical ounces. They are not going to be caught holding paper when the paper breaks. The second category, people holding nothing. Dollars in a savings account, treasuries in a pension fund, bond exposure in a 401k. These people are, without knowing it, on the wrong side of a $2. 3 trillion vote. The entities selling those treasuries are not selling because they found a better bond. They are selling because they believe the underlying currency those bonds are denominated in is going to purchase less euro, possibly dramatically less euro, over the next decade. And when 3 trillion moves out of dollar assets, eventually the price of the things priced in dollars adjusts. Oil, food, metals, everything. That adjustment shows up in your grocery bill and your energy costs long before it shows up officially as inflation. The third category, people holding physical metal, allocated in your possession, serial numbers you can verify. This is the group that history has consistently vindicated in every structural dollar break since 1971. Not always comfortably There are crashes, margin hikes, coordinated paper dumps designed to shake you out. The 39% COMEX paper crash in late January 2026 was designed for exactly one purpose: to get physical holders to sell their metal before the physical reality of the Treasury liquidation gets priced in. The paper premium in Shanghai didn't blink. The premium held through the entire dump. Now let me show you the impossibility that the math establishes euro, because this is where the controlled outrage is appropriate. Because this number should disturb you. The Federal Reserve is currently the buyer of last resort for US Treasuries that foreign governments will not purchase. When Japan sells $200 billion in bonds and no private buyer steps in, the Fed steps in. They expand their balance sheet. They create new dollars to purchase those bonds. That process has a name, shaju, monetization, shachiro, and it is the mechanism by which the purchasing power of every existing dollar is quietly diluted. Not announced, not headlined, just executed at 3 a.m. in a Federal Open Market Committee repo operation that nobody covers. Here's the number. The Fed's balance sheet expanded by approximately $400 billion in the same 12-month period that foreign holders dumped $2. 3 trillion in treasuries. They absorbed a fraction of what was sold. The rest was absorbed by domestic U.S. investors, pension funds, money market funds, U.S. banks, who are now holding more treasury risk than at any point in modern history, at interest rates that barely compensate for real inflation. The system is transferring treasury risk from sophisticated foreign sovereigns who want out euro to domestic U.S. institutions and retail investors who do not yet understand what they are holding. Wall Street is not confused. They know exactly what this means. The retail investor has not been told. But here is what should really unsettle you. The 3 trillion is not the end of the selling. It is the beginning of the acceleration, because the mechanism driving the selling is self-reinforcing. When countries sell treasuries, U.S. interest rates rise because the bond price falls. When interest rates rise, the U.S. government's debt service costs increase. The U.S. currently carries approximately $2 trillion in total federal debt at a weighted average interest rate of 3. 8% annual debt service is approximately $1, 37 trillion. Every 25 basis points of rate increase adds roughly $90 billion per year in additional interest expense. The government has to issue new bonds to cover that additional interest. New bonds require new buyers. If foreign demand is declining, the Fed or domestic institutions absorb it. More dollars created to buy more bonds. More dollar dilution. More reason for foreign holders to sell. The cycle accelerates. This is not a hypothesis. This is the arithmetic of a debt spiral. And the question is not whether this dynamic is occurring as it is aro, but how fast it reaches a velocity that the paper pricing mechanism for gold and silver can no longer suppress. Now I want to give you something specific to watch, because analysis without a frame for action is just entertainment. The next COMEX delivery period for silver closes on May 30th, 2026. In the days leading into and around that delivery period, watch 3 numbers. First, registered COMEX inventory. If it drops below 30 million ounces, we have entered the critical zone. Below 25 million ounces and the ratio to open interest becomes catastrophic. Below 20 million, and this is no longer a theoretical stress, it is an operational one. Second, the Shanghai premium. It is currently $28 over COMEX spot. If that gap expands to $35 or above during a period of COMEX paper stability, meaning the premium is widening, not because COMEX crashed, but because Shanghai buyers are bidding higher RO. That is the signal that physical demand is overwhelming the paper price mechanism from the buy side. Third, AW, and this is the one most people are not watching, ARU, the CFTC Commitment of Traders report for the week of May 20th. The COT data shows the positioning of commercial banks versus speculative money managers in silver futures. Watch for any increase in the commercial net long position. Recall that JPMorgan is already fully long. If other commercial players are rotating from short to long, it means the paper trade that has suppressed the price for decades is unwinding from the inside. And here's where I need to say something directly to the people who have been accumulating physical metal and have watched the paper price swing 40% in either direction and felt the doubt creep in. The paper says X, the vault says something different. The Shanghai market is paying $28 more than what your broker quotes. The Perth Mint suspended wholesale orders when silver was still at 117. The US Mint repriced Silver Eagles 86% overnight. Indian dealers defaulted on deliveries they had already been paid for. These are not retail glitches. These are the physical market refusing to honor the paper price. The premium held through the entire dump. It held through the margin hikes. It held through the coordinated 72-hour crash that wiped $10 trillion in paper value. Physical reality does not negotiate with paper prices. It outlasts them. And here is the framework for understanding where we are in the cycle. In 1971, when Nixon broke the dollar-gold link, the official gold price was $35. Gold reached $850 by 1980. That is a 24 times move over 9 years from the moment the paper system acknowledged what the physical market already knew. In 2008, silver was $850 at its crash low. It reached $49 in April 2011. That is a 7 times move in 30 months. We are not in 2011. The conditions are more extreme. The paper-to-physical ratio is higher. The central bank gold demand is higher. The Treasury liquidation is happening faster. The geopolitical fragmentation driving dedollarization is structurally more entrenched than anything that existed in 2008 or 2011. The Tudith. $3 trillion is not a data point about bonds. It is a data point about the end of the credibility of the system that has priced your metals at suppressed levels for 50 years. And the paper market is the last piece of the puzzle that has not repriced. Now let me give you the subscription prompt because what I am going to cover in the next video is directly connected to what I have shown you today. And you need to see it. Subscribe right now. Turn on the notification bell. Because the May 30th COMEX delivery window is going to generate data on registered inventory, on delivery requests, on who steps in to deliver and who cannot that will either confirm or stress test everything I just showed you. I am going to break down that data the day it becomes available. If you are not subscribed, you will see that video 3 days late. In a market moving this fast, 3 days is a fortune. Let me leave you with this, because I want you to carry one image out of this video. There are 3 types of people watching right now. The first type hears $3 trillion in Treasury selling and thinks, that is a bond market story. It does not affect me. They go back to checking their stock portfolio and they do not think about this again until the price of everything they buy has already moved against them. The second type feels the urgency but does not know what to do with it. They are frozen between the paper price they watch every day and the physical reality they can feel but cannot yet quantify. They want to act, but they cannot get themselves to move. The third type, Arobro, and I believe this is you, or you would not still be here, Awo. The third type understands that the signal and the move are separated by time, that by the time the mainstream financial media confirms what the $3 trillion is signaling, the paper price will have already made its move, and that the only position that survives a paper break is one that is not made of paper. The Fed can buy treasuries. They can expand their balance sheet. They can suppress interest rates and manage the yield curve. What they cannot do is manufacture physical silver. They cannot mine it. They cannot create it on a spreadsheet and deliver it to someone in Shanghai who is paying $28 above spot to hold it in their hands. $3 trillion moved away from the dollar. The physical market felt it immediately. The paper market has not priced it yet. That gap RWRO between what the paper says and what the vault already knows ORRs, that is the trade of the decade, and it is still open. There is one number I am watching between now and the May 30th COMEX delivery close that could change the timeline on everything I have shown you today. And when I get it ORRO, when the data drops row, you need to be there. The question I am leaving you with is this. JPMorgan holds 750 million ounces of physical silver. The entire COMEX registered inventory is 34 million ounces. If JPMorgan is the primary entity capable of making deliveries RWRO, and the January 7th data showed them providing 99% of all deliveries in a single day RWRO, then what happens to the paper price the day they decide to stop delivering and start selling into the open market instead? That day has not come yet. But the $3 trillion suggested is closer than the paper price is telling you. This is the hidden economy, because the real story is never on the surface. I will see you when the delivery data drops.